So you want to own a self-storage facility. Here's the pitch, and it's not wrong. A metal box cut into smaller metal boxes, rented by the month. No inventory. No real customer service line most days. Almost no labor. Operating margins of 60 to 78%, among the highest of any asset class in commercial real estate. That combination has pulled more institutional capital into this sector over the past 2 decades than into almost any other small commercial property type. What follows is what actually determines whether a specific deal works, because the margin headline and the actual return are 2 very different numbers, and the gap between them is where most first-time owners get hurt. The build. Single-story metal construction runs $25 to $75 per square foot. Climate-controlled adds $8 to $15 per square foot for HVAC. A representative 30,000 square foot, 250-unit facility costs roughly $1.5 million all in, $1.05 million construction, $450,000 land and site work. Multi-story urban infill product runs $55 to $170 per square foot before land, driven by structural steel, elevators, and fire suppression, and it's increasingly the only format that pencils in dense metros where land costs have priced out single-story drive-up. Land alone is typically 25 to 30% of total project cost, and site prep, grading, drainage, utility hookups can add another $5 to $80 per square foot depending on the parcel. Unit mix drives revenue per square foot more than almost any other design decision. The optimal blend, roughly 30% small units in the 5x5 to 5x10 range, 50% medium units from 10x10 to 10x15, and 20% large units up to 10x30 is what generates the $8 to $15 per square foot in annual NOI that underwriters target. Small units rent for a far higher rate per square foot than large ones, the same way a studio apartment rents for more per square foot than a 3-bedroom, so a facility that's overbuilt with oversized units is leaving yield on the table before it even opens.
There's a second build decision that matters more than most first-time developers realize: build to core versus acquisition. Developing a new facility from raw land typically yields a stabilized return several hundred basis points above what the same finished, stabilized asset would trade for if you simply bought it from someone else. That spread, development yield minus acquisition cap rate, is called the development spread, and it's the entire reason sophisticated operators build new supply instead of just buying existing facilities. You're compensated for construction risk, lease-up risk, and the 18 to 36 months it takes to stabilize occupancy. Once a facility is stabilized at or near 90% occupancy, it can be refinanced or sold at a materially lower cap rate than the yield it was built to hit, which is the actual profit mechanism behind most institutional storage development. You're not really in the business of collecting rent. You're in the business of manufacturing a stabilized asset and then selling the stabilization. The underwriting, plainly.
On the 250-unit example, $375,000 in annual rental revenue at 90% occupancy, roughly $125 average monthly rent. Operating expenses, management, taxes, insurance, utilities, maintenance, run approximately 30% of revenue, leaving a 70% operating margin and $262,500 in NOI. At a 75% loan-to-value mortgage, 7.5% interest, 25-year amortization, debt service runs roughly $94,500 annually, leaving $168,000 in annual cash flow against $375,000 in invested equity. That's a 44.8% cash-on-cash return in year 1. No other small commercial real estate category routinely underwrites anywhere close to that, which is precisely why storage cap rates compressed so aggressively through the 2010s. And why competition for well-located sites is now intense enough that land cost has become the binding constraint on new development in most metros, not construction cost. Mechanism 1. Pricing runs backwards. In most rental real estate, loyalty is rewarded. In self-storage, it's taxed. And this is deliberate, modeled, revenue management strategy, not an oversight. The advertised street rate is bait, calibrated to win price-sensitive new tenants who are actively comparison shopping across 3 or 4 nearby facilities on their phone before they ever call.
The rate an existing tenant actually pays after 2, 3, 5 years in the same unit is typically higher, sometimes substantially so. Industry pricing guidance is explicit about the mechanism. Increase existing tenant rates aggressively and automatically. Hold street rates competitive to keep move-ins flowing. In some markets, REIT-operated street rates run as much as 50% below what long-term tenants are currently paying for the identical unit in the identical building. The logic is pure switching cost economics. A new prospect has nothing at stake and full information. They can compare 5 facilities in 10 minutes online. An existing tenant has furniture, boxes, sometimes a vehicle already inside that unit, and the actual cost of moving it all out to say $15 or $20 a month, the truck, the labor, a free afternoon, exceeds the savings almost every time. Revenue management software automates this entirely. Once occupancy within a given unit size crosses a threshold, the system raises the rate for that size automatically, and existing tenants receive scheduled increases on a rolling basis, regardless of what street rate is currently advertised. Operators are advised not to worry too much about losing a small percentage of existing tenants to these increases, because the replacement tenant, even at a discounted street rate, often isn't meaningfully cheaper once you account for the promotional discount used to win them in the first place. This single mechanism, existing tenant rate management, is the largest single driver of same-store NOI growth across the publicly traded storage REITs, more than occupancy gains, more than new ancillary products. Mechanism 2, the insurance nobody notices, is nearly pure profit.
Almost every facility requires tenants to carry insurance on their stored goods, either their own homeowners or renters policy, proof required at move-in, or the facility's own tenant insurance or tenant protection program if they don't have one. Roughly 80% of tenants end up on the facility's own program because most people don't have proof of existing coverage handy at move-in, and the in-house option is the path of least resistance. Here's what that program actually costs the operator. Essentially nothing. A typical protection plan charges the tenant $9 to $12 a month for around $2,000 of coverage. The underlying risk transfer to the actual insurance carrier costs the operator roughly $1.35 a month. The operator keeps the rest, a margin of 85 to 90%, or on the tenant insurance model, a straight revenue share from a third-party carrier, typically 30 to 60% of the premium, with no claims risk sitting on the operator's own books either way. Run the math on a mid-sized facility. 600 units, 90% occupancy, 80% of tenants enrolled, roughly $10.65 in monthly profit per enrolled unit, and you get about $4,600 a month, $55,000 a year, generated with zero capital expenditure and zero incremental labor. On a larger 2,500 unit portfolio with half the tenants enrolled at $11 a month and a 40% commission, that's an extra $66,000 a year. This single ancillary line, alongside late fees, lock sales, and packing supply retail, typically adds 8 to 15% to a facility's gross revenue at a cost structure close to zero. It is mechanically the same trick as a gym's forgotten membership or a car wash's rarely used subscription, revenue that requires almost no service delivery, sold to a captive customer at the exact moment they have the least leverage to say no, standing in a rental office with a truck full of furniture outside. Mechanism 3. The lien. Every self-storage lease grants the facility a lien on the contents of the unit from day one, written into the standard rental agreement before the tenant ever moves a single box inside. Miss enough rent, and after state-mandated notice periods, typically certified mail at multiple stages, a posted auction date advertised publicly, the facility can legally sell everything inside that unit to the highest bidder and apply the proceeds against the unpaid balance. Every state has its own statute governing exactly how: notice timing, advertising requirements, and in most states, a commercially reasonable sales standard that requires a minimum number of independent bidders, often 3, to be present. Get a step wrong, skip a notice, mistime an ad, and the operator can lose the right to sell entirely or end up owing the former tenant damages for a wrongful sale. There's a specific carve-out for military tenants, too. Under the Service Member Civil Relief Act, a facility cannot enforce a lien or lock out an active duty service member during deployment or for 90 days after without a court order. Executed correctly, a non-paying tenant still generates a partial recovery instead of a pure write-off, and critically, the unit re-enters the rentable inventory instead of sitting occupied by someone who stopped paying. This legal backstop, unique to storage among common rental asset classes, is precisely why operators can run aggressive promotions. Dollar move-in specials, no security deposit, no credit check, that would be reckless in almost any other landlord business.
The downside of a bad tenant is capped and recoverable in a way a bad apartment tenant or a bad commercial lease tenant simply isn't. Online lien auction platforms have professionalized this further in the past several years, replacing the Saturday morning crowd with flashlights auction with multi-day online bidding that reliably produces a larger buyer pool and higher recovery, while automatically generating the compliance paperwork operators used to get wrong. Mechanism 4. Consolidation and the data advantage nobody outside the industry sees. The top 5 public REITs, Public Storage, Extra Space, CubeSmart, National Storage Affiliates, and U-Haul, now control roughly 23 to 35% of the national market, depending on whether you measure by facility count or square footage, up from 14 to 17% a decade ago. Public Storage alone holds over 226 million square feet nationally. Extra Space became the largest operator by managed portfolio after its $12.7 billion merger with Life Storage in 2023. And CubeSmart, despite owning a much smaller footprint outright, punches well above its size through premium pricing in dense coastal metros, achieving rates 14.8% above Public Storage and 31.4% above Extra Space in the New York market specifically, by design, not by accident. What actually separates these companies from an independent operator isn't brand, it's data. These platforms run centralized, algorithmic revenue management across thousands of assets simultaneously, adjusting street rates in real time based on live occupancy and demand signals an independent operator with 1 or 2 facilities structurally cannot access, because they don't have thousands of comparable data points feeding the same model. When a REIT decides to cut local street rates 20 to 30% to win a local price war, an independent competitor faces a binary choice: match the cut and compress margin on their entire existing tenant base to stay competitive on move-ins, or hold price and lose the move-in volume that keeps occupancy and therefore ancillary revenue and existing tenant rate growth flowing. This is why roughly 65 to 77% of the market, depending on the measure, remains independent despite 2 decades of consolidation pressure. It's fragmented enough that no single player can dictate pricing everywhere, but the REIT's data advantage compounds specifically in the markets where they've already built density, making it progressively harder for independents to compete in exactly the submarkets REITs choose to enter.
There's a structural choice underneath this worth naming directly because it mirrors a pattern across most of these businesses. Run independently or hand operations to a third-party management platform, increasingly offered by the REITs themselves. A management contract brings the same revenue management software, the same call center, the same brand recognition that helps fill vacancies faster in exchange for a management fee plus a share of revenue. An independent owner keeps the entire margin. A managed facility trades some of that margin for access to a pricing algorithm it could never build on its own. Whether that trade is worth it comes down to one number: does the professional management actually lift NOI by more than the fee costs? And for a single asset owner without existing scale, the honest answer is usually yes. Mechanism 5. Seasonality is a moving activity function, not a weather or holiday function. May through September carries the bulk of annual move-ins, correlated with school year turnover, apartment lease expiration clustering, which itself concentrates around summer in most markets, and the seasonal spike in military relocations under PCS orders, which the Department of Defense schedules heavily around the June to August window specifically to align with school calendars. A facility that undermarkets in spring and tries to make up volume in the fourth quarter is fighting a demand curve that's already structurally closed for the year, not a curve that responds to a bigger December discount. Mechanism 6. Premium storage categories carry a different economics entirely. Standard drive-up and climate-controlled units are the base product, but covered and enclosed vehicle storage, RVs, boats, classic cars, has become one of the highest-yielding categories per square foot in the entire sector. In high-demand markets, covered vehicle spaces command $150 to $500 a month per space, a rate per square foot that often exceeds a standard climate-controlled unit, despite requiring less finish-out, no interior hallway, no climate system in many cases, just a covered or gated slab. Turnover is also structurally lower than standard units because vehicle owners tend to store seasonally or long-term rather than month-to-month, which reduces the marketing and releasing cost that eats into margin on standard units with higher churn.
A facility that carves out even 10 to 15% of its site plan for vehicle storage, where zoning and site geometry allow it, is adding a revenue category with a fundamentally better yield-to-turnover ratio than the core product, which is why sophisticated developers now underwrite vehicle storage as a distinct line item rather than an afterthought bolted on to leftover site area. The historical cycle worth knowing before you underwrite off today's numbers. Storage cap rates weren't always this compressed, and the sector has been through a genuine oversupply cycle before. New supply surged through the mid-2010s as the margin story described here became widely known and capital chased it. And by the late 2010s, several major metros, particularly in the Sun Belt, were absorbing new supply faster than demand could fill it, pushing occupancy and street rates down simultaneously in the most overbuilt submarkets. The REIT's same-store NOI growth, the metric that most directly reflects existing tenant rate management working as designed, slowed materially during that stretch, and it slowed again through 2023 and 2024 as post-pandemic moving demand normalized and new supply delivered from the prior development cycle finally hit the market.
As of 2025 and into 2026, new construction starts have moderated significantly compared to the mid-2010s peak, and industry data shows new supply falling as a share of existing inventory, which is generally supportive of pricing power for existing operators. But it also means the easy development spread economics described earlier are harder to find today than they were a decade ago, because the best located, least competitive sites have already been built on. Anyone underwriting a new development today should model against today's more moderate development spread and today's more competitive submarket dynamics, not against the returns achieved by operators who built a decade ago into markets that hadn't yet been discovered by institutional capital. The tax structure most first-time owners underweight entirely. Self-storage benefits from real estate's standard depreciation shield, but the ratio here is unusually favorable. Because so much of a facility's value sits in the metal building shell, doors, and site improvements rather than in long-life structural elements, cost segregation studies routinely reclassify a large share of total project cost into shorter depreciation schedules, 5, 7, and 15 years, instead of the standard 39-year commercial real estate schedule. That accelerated depreciation can shelter a meaningful share of the facility's actual cash flow from tax in the early years of ownership, which materially changes the after-tax return relative to the pre-tax cash-on-cash number most people evaluate a deal on. And because storage is real property, it qualifies for 1031 exchange treatment, letting an owner sell a stabilized facility and roll the full gain into a new development or acquisition without triggering capital gains tax at the point of sale, which is exactly how many storage operators compound the build-to-core strategy described earlier across multiple properties over a career without ever recognizing a taxable gain until a final sale. Two ways to actually get exposure to this sector, and they are not the same trade. Everything described so far assumes direct ownership. You buy or build a facility, you carry the debt, you capture the full cash-on-cash return and the full downside. There's a second path, buying shares of the public REITs themselves, and it's worth being precise about how different that trade actually is. As a REIT shareholder, you get fractional exposure to the same underlying mechanisms, existing tenant rate management, ancillary revenue, algorithmic pricing, at institutional scale, with full liquidity and without ever touching a lien auction or construction budget. What you give up is the leverage. A REIT's same-store NOI growth in a normal year runs low to mid-single digits, meaningfully lower than the 44.8% cash-on-cash return in the direct ownership example, because that direct ownership number is inflated by 75% leverage on a single asset, concentrated risk a diversified REIT structurally can't and shouldn't take on any single property. Extra Space has compounded its dividend at a 10.3% annual rate over 20 years, Public Storage at 7.8%, both real, durable, boring compared to a successful direct deal, and far more resilient than a single over-leveraged facility during a downturn, like the one that caught Silverstar. The honest way to frame the choice. Direct ownership offers a genuinely exceptional return. But it's a return earned by taking on construction risk, lease-up risk, single asset concentration risk, and active management, mixing tenant, chasing collections, running the lien process correctly. REIT ownership offers a diversified, liquid, professionally managed claim on the same sector's structural advantages, at a return that reflects the absence of that risk and that labor. Neither is the correct way to access this sector.
They're different points on the same risk curve, and most of the return difference between them is explained by leverage and concentration, not by some hidden edge the direct owner has that the REIT doesn't. Where the model breaks. Silverstar Properties is a Houston-based public REIT that spent years as an office landlord before office demand deteriorated sharply, and it attempted a wholesale pivot. Sell off office assets, redeploy the capital into self-storage, a sector with the margin profile just described. On paper, that's a reasonable strategic response to a dying asset class. In execution, the company filed for Chapter 11 bankruptcy in May 2026, its second bankruptcy filing. The balance sheet at filing showed $100 million in assets against $75 million in liabilities, a ratio that on its face looks survivable, comfortably asset-rich. But 4 loans were already in default at the time of filing, and a specific self-storage property, the exact asset class this pivot was supposed to de-risk the company into, was already headed to foreclosure over a $5.75 million promissory note.
The failure here wasn't the storage operations themselves. Nothing in the public record suggests the actual facilities were underperforming on occupancy or rate. The failure was capital structure. A company transitioning an entire portfolio between asset classes took on transition financing debt faster than the new storage assets could generate stabilized cash flow to service it. The same lease-up timeline problem described earlier in the development spread discussion, except funded with leverage that assumed the stabilization would happen faster than it did. This is the specific risk storage's low capex, high-margin reputation tends to obscure from lenders and operators alike, because the operating margin is genuinely 70+% once a facility is stabilized. Debt against storage assets gets priced and sized as though that margin is available immediately, when in reality, every facility and every large-scale portfolio transition has to survive an unstabilized period first, and it's during that period, not after, that most storage-related capital structures actually fail. 5 numbers to check before underwriting any specific deal. First, economic occupancy versus physical occupancy. Physical occupancy just measures how many units have a tenant in them. Economic occupancy measures actual collected rent against total potential rent at current street rates, and the gap between the two numbers is where existing tenant discounts, delinquencies, and promotional move-ins hide. A facility showing 92% physical occupancy but only 78% economic occupancy is carrying far more legacy discounting than the headline number suggests, and that gap is either an opportunity, you can raise existing rates toward market, or a warning sign that the operator has been buying occupancy with unsustainable discounts.
Second, the unit mix ratio against the 30-50-20 benchmark described earlier. A facility skewed heavily toward large units is generating less revenue per square foot than its footprint should support, and converting unit mix after construction is expensive relative to getting it right in the initial design. Third, ancillary revenue as a percentage of gross. If it's meaningfully below the 8 to 15% benchmark, that's usually a sign of an undermanaged tenant insurance program or a facility that's never bothered to build out lock and packing supply retail, both of which are close to pure margin upside a new owner can capture quickly without any capital investment. Fourth, the debt structure itself, specifically whether it's fixed or floating rate and where it sits relative to the facility's actual stabilization timeline. The Silverstar failure wasn't really about the storage assets underperforming. It was floating rate, short-fuse debt sized against a stabilization timeline that didn't happen fast enough. A facility can have excellent unit economics and still be a bad investment if the debt behind it doesn't match how long real stabilization actually takes. Fifth, submarket supply in the pipeline, not just what's built today. Storage permitting and construction data lag real-time by months, and a facility that looks undersupplied today can be walking into 3 new competing facilities that are already under construction a half-mile away. Checking permit filings and construction starts data for the trade area is a 5-minute step that a surprising number of first-time buyers skip entirely.
On the $1.5 million, 250-unit example, roughly $94,500 in annual debt service, plus $112,500 in core operating expenses, means the facility needs about $207,000 in collected core rent just to clear its obligations, against $375,000 in potential core revenue at full occupancy. That's a break-even occupancy of roughly 55% before a single ancillary dollar is counted. Layer in tenant insurance participation at a conservative 70% enrollment and $9 average margin per enrolled unit, and that adds close to $19,000 a year in near zero cost revenue, which effectively lowers true break-even occupancy by another 3 to 4 points. Above break-even, this is one of the highest cash-on-cash returns available in commercial real estate, a 44.8% year-one return in the base case. Below it, the same leverage that generates that return starts working in the opposite direction just as fast, and the Silver Star case shows exactly how quickly a stabilized return model becomes a bankruptcy filing once the assumption of fast stabilization turns out to be wrong.